I'd like to thank everybody for joining me today. Since we just got past our final tax filing deadline for this year, I thought this would be a good time to talk about helping our clients, do more planning, find that lost money that is going to taxes that with the right amount of planning can help them save money, reposition that and other things for them and for their business. In a perfect world, if our clients had unlimited money, they would love to invest more, buy life insurance, and do all of the planning ideas that we have. So as advisors, if we can help our clients, reposition things, do more planning, but save that tax money and use it for the planning ideas that we come up with and those strategies, we're going to have more success with our clients, and our clients are going to have more success with their planning. But funds are limited. They need our help. And it starts with understanding with what taxes we're planning for. If you think about the taxes, if each type of tax requires different planning. So if we're talking about payroll tax, most employees don't know that their employers are matching their payroll taxes. Half of it comes from the employee, half of it comes from the employer side. If you're self-employed, you get to pay both, and you've got a big payroll tax bill. So if we can do things to reduce that payroll tax, that's money in our client's pocket. One way we can do that, we can use S corporations and have a reasonable salary, but all of those distributions that come out to our clients from the S corporation are not subject to payroll tax. There again, it's a 15+% savings just in that tax alone. With income taxes, our clients are used to paying income tax. They're used to filing for income taxes. Now, if you think about this, if we can do more planning here, reduce that pain of the income tax. But part of this is getting the right, planning in place, using the right business structures, helping them understand that they can be doing more charitable contributions. I look at a lot of this. Sometimes we're doing charitable contributions. Yes, that's to help the charity, but in more cases, we're doing that to save our clients money. So look at those planning strategies that can leverage those dollars and help our clients reduce that income tax bill. Finally, with capital gains, capital gains taxes occur when our clients are selling a large asset or selling their business. And I hear this a lot when I see clients are selling their business. And if they haven't planned, they're shocked at how much that capital gains tax is going to be or will be. And the other comment I hear from a lot of clients as they sell their business, they've never done this before. And so for these clients, that capital gains tax in a lot of times is a shock. It's a surprise. I didn't expect it. I didn't realize this sale would generate that kind of a tax. There again, pre-planning before the sale can help that. two planning strategies that we use. If we're doing it before the sale, and if we've got the right parameters, we can use a charitable remainder trust. With the charitable remainder trust, we can reduce that tax bill, create a big tax deduction, and generate income that can be for a set number of years, for single or joint lifetime, and then eventually benefit charity with whatever's left. So great tool, pre-planning. After the sale, and we see that we have a large charitable or large capital gains, we can use qualified opportunity zones. With qualified opportunity zone, you just have to invest in the capital gains portion of that transaction. And if you leave that in for 10 years, you not only eliminate the current capital gains tax, but all future income tax associated with the appreciation of that asset. There again, just two strategies to think: pre-planning, post-planning. Which one fits? We just have to know and work with our client. A lot of times when we start looking and working with the new clients, gathering information is the key. We've got to understand what our clients' goals and objectives are. And also, we've got to take the time to understand their tax picture. Ask them for tax returns. Ask them for business tax returns. All of this comes together so that we're looking and working off the same page as our clients. And we're helping them position these strategies in a way that will save them money, but also help them achieve their goals. I see a lot of clients that get put in positions that they didn't expect. Well, they didn't vet out the strategy, or they didn't explain what their goals are. It wasn't the problem of the strategy in most cases. It was the application of the strategy to the wrong situation. So when we're looking at tax returns, we can learn a lot from just looking at the tax returns of ways to help our client. If I'm looking at a partnership tax return, well, I already know looking at a 1065 return, it's a partnership tax return. We're going to have self-employment tax. Whatever income is generated in here is fully subject to self-employment tax for a general partner, not necessarily for a limited partner. So there again, it's easy to be aware of that. If I look and they have depreciation, well, if they have depreciable assets, now we can look at the type of assets they own. If they have real estate and they have not done a cost segregation, this is a great way to accelerate that depreciation, which may be, that they're stretching out over 20, 30 or more years. And we can take that deduction now. When we're looking at tax planning, always look at this. Number one, can you get out of paying that tax legally with the right strategies and planning? Number two, if I can't get out of paying that tax today, can I defer it to a future year? And cost segregation allows us to, take that deduction now. Yes, we're not getting depreciation deductions over the years because we're going to take it now, keep more money in our pocket now versus later. The other things that we start looking at is we look at depreciation. There again, we can do the cost segregation, accelerate that depreciation, but be aware, if they are subject to passive activity loss rules, so if they're a doctor investing in a rental property, they're only going to be able to take deductions up to the amount of income that they receive. The rest of that is subject to passive activity loss limitation, and they will not recoup those expenses until they sell the property. And so, adding more cost segregation to something already subject to a passive activity loss limitation doesn't make sense. There again, the cost segregation is not a bad strategy. It's being applied the wrong way. So we have to just look at all of the tax return to get those answers. If we have a business that they have, high income, high taxable income, we might want to look at a captive insurance company under 831B. This allows the taxpayer to take a large tax deduction to cover the risks of their business. The uninsured risk, they've got their other commercial insurance policies, but we're using the captive insurance company, A, to cover those risks, B, to allow them to have a larger tax deduction and create efficiency in their tax planning. If I look in the business return and I see, retirement plans, employee benefit programs, or there's nothing on those lines and I know this client has employees, we might want to have the conversations. How about key employee retention? What would happen to this business if our key employees no longer showed up for work or they left? How bad is this company going to be hit? When we're looking at the employee benefits, we can look at Section 125 plans and enhance the benefits on a pre-tax basis to our employees. We might want golden handcuffs to keep our key employees and provide them long-term benefit. And we can look at R&D credits with our employees. There again, creating these things that allow us to keep our employees and provide benefits to them that are meaningful to them and to their family. If I come over here and I'm looking at a high income, what type of retirement plans are we providing in the business? Do we have a 401k? Do we want to add a profit sharing plan to that? Do we want to, if we've got a limited amount of employees, can we go to a defined benefit plan? Or if we want post-retirement medical benefits, we can do that with 401h. So the opportunities are there. We need to take the time to spot the opportunities, but remember to ask for the information from our client. Have them fill out questionnaires. Take the time to get that information. Take the time to get the tax returns. Help our clients reposition their assets, reposition their income, create deductions that are legitimate to help them keep more money in their pocket to do other planning opportunities with us. I appreciate everybody getting on today. If you have questions, reach out. If not, we'll talk again next week. Thank you.